Actually, I'm pretty sure the guy ended up going to prison because this was one of like 19 deals that had go south on him.
Wow.
And I think we've dealt with some good sellers over a 15, 18 year period, and we were more trusting than we should have been. Now what we do differently is we walk every single unit, and then if it goes past so many days, we walk every single unit again. The thing is, I'd rather the seller be upset at me than putting LP's equity in danger.
The views expressed in this podcast are those of the individual guests and do not reflect the opinions or recommendations of Invest Clearly. This podcast is for informational purposes only and should not be considered investment advice. The appearance of a sponsor or investor on this show does not constitute an endorsement or a warning. Invest Clearly is an objective and neutral platform. Always do your own due diligence before making any investment decisions.
Brian, thanks so much for joining me.
Yeah, man. Thanks for having me on.
Yeah, I'm looking forward to our conversation. Obviously, we had a chance to catch up a little bit earlier, so I'm looking forward to diving into your journey. Before we get started, I'd love for you to just take a minute and introduce yourself to our audience and anyone who might not know of you.
Sure. Brian Ferguson. Our company is Fergmar Enterprises and Fergmar Capital. We've been in the real estate space in some form or fashion since started in 2005, so almost 2 decades ago. Started out just as a side business, fix and flip, and then that transitioned over time into, we ended up with about 150 single family portfolio that some houses we couldn't sell, and then we started growing that portfolio. Fast forward over that 15-year period, we eventually 1031 out of those, started buying multifamily just for scalability purposes. And then over time, we have a ground up division, did some ground up land development. So we've been in multiple different facets in kind of the Victoria, Texas area. And then we transitioned into pure multifamily and shopping centers in the past 5 or so years. And we're currently in the Victoria, Texas market, Katy, Texas, right outside of Houston there in shopping centers. And then recently moved into Kingsville and some other smaller markets like Victoria and the multifamily front.
Awesome. And so when you first got started, it sounds like were you raising capital when you first got started?
No. So the first deal we did with outside capital, private investors or lenders over time, but like as a syndication model or JV model, our first deal with outside capital was in 22 on a shopping center we bought. So about a little over 3 years ago now.
Awesome. Why'd you start to make the shift? Walk me through, like, you've been doing it for a long time on kind of without that model, and then you make the shift to bringing in LPs. What was the motivation?
So without kind of getting too long-winded in it, what would happen is when we decided we wanted to get out of the single family front, the market was really good. So you could go put 5, 10, 15 houses on the market out of this portfolio we had. And we didn't owe a lot, if anything, on some of these because we'd bought them, these were tax sales back in 05, 06, you're buying $10,000 for them. So, but there was enough capital to go buy something of scale, because what we didn't want to do is sell something and then go buy another fourplex, which is what we didn't want. But then what happened eventually, as you started selling that off, we built a pretty nice portfolio up, but you'd sell something and all you'd have in this whole 6-month period is a couple $100,000. Well, I'm not buying anything, even with bank leverage. I'm not going to buy what I want for a couple $100,000 in cash. So we started doing some private lending to other people that were getting started in like fix and flip. And then I started putting my money as an LP in other people's deals. And that's where I knew the syndication world, but never really paid a lot of attention to it. I started paying more attention, going to some conferences, meeting some people. And then I had met some other guys. I from time to time would have people approach me that they wanted to be passive. That's not what they were calling it. They were just like, hey, I have money. I want to invest in real estate. I don't want to do the work. I'm like, oh, we now call that being an LP.
Yeah.
And a lot of guys had mentioned this over time. And I had a couple brothers that had mentioned this to me. There was a shopping center deal that had popped up, brought it to them, and a group of us, we bought that. And then a couple more deals went that way. And then I started getting the referrals, people calling me saying, hey, I heard you did this deal with so-and-so. I have some money I'd like to invest. And we were just doing it deal by deal. Then eventually we learned, okay, if we don't have some type of active deal flow, if we're not, we can't just buy it only because what I was doing was I have money, so I want to go buy something. Now I'll ask if anyone else wants to put money in. Well, that doesn't service their needs of when they have money they need to deploy. So we've just gotten more intentional how we do it now. Starting about last year, that's when we kind of really created the Fergmar Capital side of it, and we're taking investors full time now.
Got it. Interesting. So was the shift there, obviously, that you started as an LP, really, is what you're saying. So you
syndication,
exposed to syndications through like deploying your own money and realizing like, oh, geez, this could work for my business.
Yeah. Well, I thought that I was going to be done. So I had actually I'd gotten a divorce in 16. I'm remarried now. We have an amazing family, but I got my divorce. I started slowing down a little bit. I started putting the money as the LP. I was kind of, when me and my wife now started dating, I was traveling a lot with her. I thought, I've done well enough. I'm just going to be done. And then that worked for a year or two. And I'm like, okay, that was fun, but I'm not ready to be done. I still want to be I'm 39 right now. I'll be 40 in January. So I was 35, I just wasn't, I thought I was ready and the LP thing worked out fine. I wasn't ready to be done. I still wanted to be active. Our experience of almost 20 years now is in operations and in management. And that's what we thrive off of. So it was tough for me to just write a check and then watch what happened. I'm the LP that dives into the financials in depth. I ask for the full set and then I see variances and I'm like, well, did y'all try this? Did you do this? And I could tell I was kind of starting to annoy some of the GPs and this.
You weren't passive.
I was not. I'd make trips to I had to deal in Houston. I'd go down there just to grab lunch and drive through the property. I was like, this isn't for me, not yet. So that's what transitioned me. And then, like I said, we had a group of guys. We found the shopping center. It was good timing. It worked out, and we bought that, and the deal worked out really well. We bought another one, and then just kind of it became full time.
So, in your experience as an LP early on, I'm curious as to how that shaped your approach to bringing in your own LPs. Obviously, that was a pretty tight timeline there. You became an LP, you started observing what was going on, you realized this was something you could do and started going out looking for LPs. How did your own experiences as an LP shape your approach to bringing on your own LPs?
It shaped it in what I thought was great, and then I came in to realize I was wrong. So I'll say that. But what I did is I took all my notes when I did this and I thought, okay, I've done this. I put my money out here. I know what I do like, what I don't like. I know what I like about how they communicate. Here's the things I'd want to see more of. So I wrote what I thought was the Fergmar Capital playbook on how we're going to communicate to LPs based on exactly what I wanted to see and what I thought I didn't see enough of. Now, if you fast forward that, I'll say that was a big issue because I tried to communicate with whether it be 2 people or 20 people or 100 people, I was communicating all of them exactly on my playbook of what I wanted to see. And until I had someone at a breakfast tell me that I was virtually annoying them and that I was making this a full-time job for them. I never realized that. I still think some of the knowledge I gained and where I saw, I still think there's certain things that these GPs, it was a flaw that they could have done better. But then I've also realized there were certain things that they weren't communicating that now I don't communicate. I don't send out a full 85-page P&L, document set in every update. If you ask for it, I'll send it to you. But I don't send it to everyone in the deal because now I know they don't want to see that.
Sure. They're deploying their money to, so you can handle it. They're not looking to okay. So that double clicking on that a little bit, what you're saying, if we could just spell it out for everybody is, as you said, you're the guy that's diving into the details, driving the property or, hounding the GP for information. You thought, okay, I'm going to jump in here. I'm not going to make people hound me for information. I'm just going to give it all to them. And some of them like that. And some of them were like, hey, net it out for me. I gave you my money to
He literally told me that. He said, you told me this was going to be, I write you a check, you go make me money. He goes, now this is a job. And in that same conversation, we were talking about a future deal coming up. And he was explaining this to me on why he was having hesitation about writing another check. He's like, I get I'm making money, but I don't want to have to do all this. When I was like, well, it's not expected of you to do the work. I just sent it in case you wanted. He was like, well, I don't want to see all that. He goes, now when my distribution stop, I may come to your office and have a different conversation. He said, but this is a guy, this is generational money. He goes, but I'm not the one coming to your office. I'm going to bring in my people and they'll come sit in your office and look through financials if things get bad. And then he also told me in the same setting, because he had one of his very close friends, they normally, if one of them writes a check, the other one does. And I couldn't get the other guy interested at all. He said, the problem is you bring us in there and you have these 85-page presentations about how the deal and all the numbers. He said, and we leave there and we're confused.
Right.
It sounds like it's a good deal. He goes, we just want you to sit us down, look us in the eye, explain it to us. And I'm like, so you don't want to see, he goes, I want to see one page what my returns will be based on how much of a check I write. I'm like, so you don't want to see the other 78 pages of research and comps and stress tests? And he's like, nope, we don't want to see any of that. But then I got the other side of the spectrum. That's exactly. So I'm very diligent I try to meet them where they are. I take notes. We use HubSpot. I try to make sure I put diligent notes in there. And I go back and look at those notes before I have a phone call with someone because I move 1,000 miles an hour sometimes. And what I don't want to do is what I used to do. I'd get on the call and I could immediately tell where I lost interest in a phone call.
Yeah, definitely.
And I either didn't give them what they wanted, and so they lost trust in me, or it wasn't a trust factor. It was this guy's annoying me with too much data and I just don't want to talk anymore. So it is tough because you have to realize that I can want what I want as an LP when I'm writing a check, but that doesn't mean that these other 500 people or 100 people have to want the same thing. And I have to be very intentional on that because if not, I will get fascinated on these certain details of a deal that are very important to me, not so important to them.
Right. Well, I think there's a lot of truth to that, and I've heard a lot of other GPs, and would probably anybody who's listening consistently to this podcast will hear that this is a topic that comes up a lot. It's where's the line on what to communicate and what not to communicate, and we can jump into that a little bit more in a second. But I think what you're saying is even further up in the process. Usually, when we're having that conversation, it's while the deal's operating. Like, what if something's where's the line on what to communicate when something's going wrong or something's going sideways? Like, how much, like, obviously you want transparency, but you don't want to overwhelm people, like, because they did hire you to do this. You're saying even earlier in the process, you're kind of taking into account, like, what type of person am I talking to? And what might, so when do you start that? Like, when's the,
So I'll tell you where it is. So, when we're building our, we call it an OM, some people call it a pitch deck, whatever you want to call it, but we've gone back and forth on how much data we put in there. I've taken stuff out and then someone asked, so I put it back in. Well, I went to it was actually the Passive Pockets conference, and I met a group of people. They were from New York and they were all getting together. They have they're like an investor group. There's like 20 of them and they view deals together, invest in deals together. It's like their own little private group. Anyway, so I flew down there and had hosted a dinner just to have dinner with them. And I told them, like, I'm not looking for a check from anyone. I just want your feedback because you've all seasoned 10, 15, 20, 30 years of doing this. And the amount of things that they asked for was insane that I just didn't think about, that I missed. They wanted more back history about this. So I had like 30 pages to this OM. Then I send it out and I have a group of local guys that are in other deals. And I had half of them in some form or fashion tell me, why did you make this thing so long?
mm-hmm.
And I'm like, okay, so I'm not saying I figured this out. It's still a battle of, I want to make sure I have enough data. But even in the beginning, it's one thing if they're sitting in front of me at a conference table and they're local and I know them, our kids go to school together.
Sure.
I would say if they have money to deploy, 99% of the time, they're going to deploy something into the deal. But where I've learned is that the battle is when you're dealing with, these people that you don't know, that maybe you've met one time at a conference or they were referred and you've never met them in person and you're sending them this OM, what they're looking for in it is completely different than the person sitting in your conference room. So we've even talked about, do you on the portal have a simplified version and an in-depth version, but then how do you explain which is which, So it's a problem we realize on what you give to them. I wouldn't say that we have a surefire way of, and at some point I won't have the capacity to do this, but I mean, every time I send it, I follow up, I personally call them, say, hey, let's talk through it. Let me jump on a screen. And I just try to pay attention to, as we're going through a page, if I see no interest, I scroll a little bit faster as I'm presenting to them. And then when they start asking questions, I try to slow down on that page. Yeah. But, we did, our investor relations, Lauren, so we built out this questionnaire. I have what I think is a pretty good questionnaire. And I've added in those questions of what data they look for. What are the most 3 important things they look for in an OM? What are the 2 to 3 important things they look like when they get quarterly updates? Outside of the distribution, right? That's one. Did I get a deposit? But what is the data you're looking for inside that update? And I try to just compile that and make sure I'm sending them. But again, that's not a permanent solution, just because if you have 250 investors, you can't send them all something different,
Yeah, that's definitely true. What it seems like that if I was to like zoom out a little bit, the difference maker is trust, right? So, you're dealing with a group of seasoned investors who are used to just looking at deals. They don't know you. They don't know the operator. Probably don't know a lot of the operators they work with. They're literally doing it based on the deal. So when you're trying to figure out how to invest that way, like every little piece matters. Like you're using that as a proxy to evaluate whether or not the operator has their head on their shoulders, right? Whereas when you're talking to someone in your neighborhood or, someone that you've built a relationship with, they kind of already in their mind are saying you have your head on your shoulders. And so they just want to know kind of what's the deal.
Yeah, because they'll
Is that,
literally tell you, like, "I'm trusting you." I had a
yeah,
guy drop off some checks the other day. He literally told me, "I will only drop off these cashier's checks with you." And I'm like, "Okay." I mean, that's fine, we're gonna have those, but he told me, he shook my hand, he looked me in the eye, and he said, I'm looking in the eye telling you, I'm just trusting you in this deal, that it's a good deal."
right.
I don't even know if he'd have the metrics memorized, whereas that group I'm emailing it to, I can promise you, they know every detail
Yeah. They're
of it.
dissecting it.
That's a good
Like,
point. Yeah, it is. I think it's a trust factor, how well you know them, and it's a good point.
yeah, they're operating borderline like almost like a mini institution would
Yeah.
operate, where they're doing kind of that like deal level due diligence. Whereas most passive investors, I think, are doing sponsor level due diligence, on the retail LP side. One thing that we hear a lot on this show, though, is, well, I'll ask you at the end what part of passive investing needs to die, and that's usually the last question. But one of the things that people often say is the idea of passivity. It seems like personally you would agree with that, like in your own approach, like passive investments aren't really passive, in the sense that there's legwork to be done up front. But on some level, like once trust has been established with the operator, that's when there can be a certain level of passivity. That's what I'm hearing from you, or that's at least that's the situation that gets
I
established.
agree. I think it depends on the person heavily, like the guys that, exited a medical company and are putting, $500,000 into a deal and, and their net worth is tens and tens of millions, right? Like it's easier for them to be passive because it's not worth their time. They'd
Right.
probably still be really upset if they lost that money, but they're not going to dig in. They're just
Right.
not. Whereas, that is something you have to be very aware of. I think being a GP, like, I just recently took some money from a guy that, like he's investing, partnering with us, but he owns a ton of rental property. And I already know that our conversation is going to have to be a little different because he's already asked in the beginning when I get my updates, if we missed a budget line item on make readies, will I have the details on why we missed it? And I'm like, no, I won't. I mean, I can, yes, but won't be actively sent to you every email, but if you ask for it, it's here.
Yeah, it's not going to be in the report, but you can ask, right?
If you want it, we're an open book, Monday through Friday, 8 to 5, and maybe some off hours. My team will print whatever you want. You are a partner in this deal. I'm fully transparent with that. But I think you just have to be aware of who that is. And, I know a lot of people go, okay, my avatar is this, and I only focus on this. And I've actually had people that have called and we've had a meeting, and I don't know if they would have invested or not, but I didn't follow up to find out because I don't think they would be a good fit for us. But then there's the ones that I go, okay, it's going to take a little bit more work. They're going to call and text more, especially on the first deal. Now, once
Right.
distributions are going great, those calls will probably slow down a little bit, but you just have to be prepared to take, but my thing on it is if you don't want to take those phone calls from I hear people call them a needy, like they're a needy LP. I'm like, I don't know. That's the terminology I would use. They're like, to your point, I think you hit the nail on the head. The trust isn't there yet. Go earn and build the trust, and they'll probably not bug you as much on the details.
Yeah, we'll call it an involved, or, like there should be a little bit of anxiety when someone deploys money with you. They don't know for a fact, right? Like these deals are not risk free,
Yeah.
so like until they see how you perform, it makes sense they're a little more involved. So on that note, I mean, obviously you haven't been taking other people's money for that long, like, but obviously the market is kind of in an interesting spot. Like there's been some ups and downs. The interest rate environment, has been challenging. So a lot of LPs have been a little bit more anxious, and a lot of the deals haven't performed exactly to the pro forma. So have you had to deal with that? Like just, kind of LPs coming to you being like, hey, are we all right? And then, have there been any, adjustments you've had to make, and how did you communicate those?
Yeah. So all the above. What has helped us is that we went through this cycle. We got into the business during this cycle. Luckily, whenever I went through that 05, 06, 07, 08 cycle,
Right.
I was not married. I did not have children. I did not have debt.
Yeah.
I had savings. I would not have wanted to go through this cycle with the size of our portfolio without that experience, because I think it could have ended very differently. We
Right.
saw the writing on the wall. We saw the slowdown. We did a reduction in force on like our big development company. We had 40 spec houses and all of a sudden nothing's selling, so we immediately started, one person's now going to do three person's jobs. We went to people that had been here a long time and said, hey, you remember 10, 15 years ago when we all worked 60 hours a week? Like we're back there. yeah, we got to get rid of so-and-so. We're going to have to let go of so-and-so and so. So we had to make a bunch of big changes. I'm a big proponent on when we underwrite deals that the interest rate environment doesn't matter if it's a fixed rate. Like if it's 18% interest and the deal underwrites at 18% interest, then it's going to underwrite better at 8% interest. So I didn't let that scare me, but we also were not, our capital or syndication company is at shared resources from everyone else in the building for the most part. They all have other jobs and get paid off of other revenue streams. So if I don't have a deal for 12 months, it's fine. So yeah, we underwrote, and if they didn't work, they didn't work. So I definitely feel for the guys to where the new fees or the new deals coming in is what paid payroll. I truly do. Some of these guys that, are in a bad spot now and people kind of kick them around. I'm like, I get that, because if I was in that, if any of our one revenue streams was the only one, it would have been really tough. But I'd say one of our biggest flaws was one of our first, we did the shopping center as our first multifamily deal. It was a smaller deal. We underwrote it a bit too aggressively. It was the only deal we ever did floating debt on. We're actually just fixing to close the refi on it probably Thursday or Friday. And then we bought this in January of 23, but we bought it. It was a higher interest rate and underwrote to that. But what we learned that the door number count, it being 56 units. We have a bunch of small stuff and then we have 100 plus stuff. So we never had that middle of the road that didn't have the budget for on-site staff. And so that was a small piece of it. But then what we learned is a fraudulent seller and that we were being too trustworthy. So it took about 6 months to get the deal closed because they found stuff in his P&Ls. Freddie Mac pulled out of the deal because he wasn't at the occupancy he said. So we had to last minute transition to a cash deal, and then went and got some bridge debt on it so we could stabilize it. If I could go backwards, we should have just walked. And now what we do differently is we walk every single unit. And then if it goes past so many days, we walk every single unit again, because this guy had put ghost leases in places. These units were trashed. That had happened from the day we walked it to when we closed 6. So, I mean, I'm pretty sure the guy ended up going to prison because this was one of like 19 deals that had go south on him. But
wow.
There wasn't enough. Our attorneys were like, you'll spend more in legal fees than what are you going to get from the guy?
Right.
You're like,
right.
Yeah, they've been going after him for 2 years now. So, but we learned the hard way there. And then what I was getting to on that was this was the first multifamily deal. It was the first deal where I went to a bunch of people at 50 and 100, like, hey, put 50 in, put 100 in. And this deal has yet to give distributions. So we've had to learn to be very honest and open about why we are where we are. Like, that's a deal that had asset management fees into it. I'd love to touch on that for a minute, because I'm not an asset management guy. I don't believe in them, or Pref, but people kick me for that one. But we paused our fees. We took them all off the table. We'll probably never end up charging them, like on that deal, I'll give up my ownership percentage to try to get them as whole as possible. It extended our hold time by about 2 years. It'll still be a good deal, but it was definitely a lesson for us, thinking we've been doing this years and years. We had never dealt with someone that was intentionally being fraudulent as a seller.
Right.
And I think we've dealt with some good sellers over, a 15, 18 year period. And we were more trusting than we should have been. And now the unfortunate thing is, even when we have good sellers, we play hardball we're like, no, I don't believe anything you say at this point. Like, if you're talking, you're lying, and I want to see it in black and white, and we want to see it with our own 2 eyes. But, the thing is, I'd rather the seller be upset at me than putting LP's equity in danger. So that was
the deal's going to come out okay in the end, but longer hold time and a lot of probably angst in the meantime.
2 years pretty much. And so now our 5-year plan starts this week on refi, and it's going to take 7 years to be successful there.
How early did you start communicating about that?
I would say we were probably, because when we first started finding these leases, it took us about 6 months really to get through all these ghost leases and start seeing where the overages was really going to come on CapEx, because these units, it was a twofold. We didn't have the income coming in, but then now the CapEx was higher than we thought, because these units that were in decent shape, we don't know to this day, did they intentionally go in there and trash them, or did they I think what we think happened is we were trying to maintain the 90%, and they were running all these specials, and we just were like, well, it's their property, they can do what they want. That's not the case anymore. We definitely put it in all of our contracts. And once we sign a contract, like, we have to communicate on, what leases you're signing, because we're inheriting these. So I think they were just putting people in with no deposit, no money, no nothing.
Oh, just really?
No. Right. Yeah. I mean, we're just putting warm bodies in there to meet the check. And they just trashed the place. But it probably took us into the second or third quarter because that's when we really had an understanding of how bad this was. And we started communicating it. And I did send out updates, but if I could go back and do it again, there's 20, say 25 people in the deal. And I had another GP that they had actually brought us the deal because they knew it was in our market and someone had put us together. So I'd say half of them are their LPs, but at least on our half, and what we should have both of us done on both halves, we should have been a phone. Like that's a situation that didn't warrant an email. It should have been. So yes, we communicated, sure, but was it enough? Should we have picked up the phone call and had 30, we owed them each a 30-minute conversation. If it took us a full week to call them all and say, here's what
Yeah.
happened. Maybe it's an hour and a half. Let me explain to you what really happened. Because they'd got the emails and then I'd run into people and what's going on with the deal. And you start explaining it and you could tell, like, I'm not sure they got all that from the email, you know what I mean?
Right. Yeah.
And so I would have definitely done that differently if I could go back and do it again. And if it happened again, that's exactly how I would do it, is phone call by phone call.
Yeah. It seems like your approach overall is like very kind of every like iteration of learning you've had that you've described here is about personalization. Like it's,
Yeah.
hey, we need to be more sensitive to like what they actually need from us and want to hear from us and how they want to communicate with us. And just kind of bringing a very relational, and we kind of putting words in your mouth here, but putting a very relational kind of lens on the LPGP relationship.
No, 100%. I mean, like we have a saying in it. So our portfolio is like 120 to 80. 120, like 120 is our assets under management. 80 of it's non-investor, right? So the biggest piece of our portfolio is individually owned by me or me and my original business partner from almost 20 years ago. So that's a much larger pool. But when we first started doing this, I'll never forget, we sat at a table and I was sitting with my leadership team and we had to talk about, I think it's like parking lot repair. Like we needed something done at multiple properties and we didn't have enough vendors, right? Because we are vendor restrained in our market. So if you need 5 of the same thing done, and they said, and one of the people at the table said, well, we're going to send them, we call it our corporate owned and our syndicated properties. And they go, well, we'll send them to the corporate owned first because we own 100% of those versus 20% of these. And I'm like, hold on a second. Like you're completely wrong. Like I look at it completely opposite of that. Like if I lose money over here, that was my decision to do it. I'm not saying I won't lose sleep, but not as much. Like I've taken these people's money and that's what causes the most loss in sleep every night is, are we going to perform to what we promised these people? You know, and especially the checks where these people are giving it to you and they're like, this is my retirement,
Right.
Like, I'm going to sell my company in a couple of years or shut my company down because some of these companies aren't sellable. But what I'm giving you, I need these dividends to start kicking in 2 to 5 years or I can't retire.
Mm-hmm.
You don't want to be. So that now everybody in our building knows, like, syndicated properties go to the top of our list and then we worry about the rest of it. So, but you know, my team knows that, but how do you get this investor that was referred to you, that's uncle for the first time? Like, how does he know or believe that? You know?
Right. Well, ideally he just reads reviews on Invest Clearly and that's how he figures it out. All right. So, well, I want to let you, you said, I want to talk about, you said I would talk about Pref, but people will get upset with me. I think you wouldn't be the first person to bring it up. So let's talk asset management fees and Pref. And then, again, we have the question, what about passive investing needs to die? So if that's what those are, maybe we just lump it into that.
100% lump it into that. And again, I can get shot all day long. That's fine, but I can take a deal. I'd love to actually think about hosting one. We've done a post on it. I thought about hosting it. I can open my underwriting sheet and plug in a 4% asset management fee and an 8% Pref, and they almost cancel each other out. And they're so close to happening. Like I don't understand putting fees, a GP fee and an LP fee, if they cancel each other out. And I don't think they're properly aligned. This is my take and my opinion on it, especially an asset management fee. I get property management fees because we own a property management company, but we also have third-party property management in other markets. We hire whoever is the best property manager. If it's not us, we use them, but we don't property manage for the fees. Property management to me is the most work in the deal. So I believe that's top line. They've collected the income. They only have so much control on expenses, but for someone from asset management to get paid on the top line of the deal, that's where I've never especially I know they're structured different, but when I see a deal that is structured on, I get my 4% asset management fee based on collected income, but that is half the battle. You can be collecting at 100%, but if the expenses have just gone haywire, the deal can die based on that. So, and then I feel the same. And then Pref is just, to me, yes, it's a preferred return, but if the cash flow is not there, it's never going to happen. So what is aligning to make sure that we do 80-20 splits. Every deal now, we just do 80-20 down, no extra fees, no nothing. It's 80-20. if we want to succeed, then we have to make sure your 80% grows and our 20% grows. Plus we co-invest in the deal, obviously, but I just think it's a cleaner structure. When I did LP deals, those were the type of deals I went for.
Mhm.
And again, but I've also been on the phone calls recently where I literally had someone say, no pref, no thanks. And they ended the phone call. I've had it happen a few times.
Well, obviously a lot of firms are offering pref and a lot of pref. And then there's different types of pref deals out there too. I mean, that's
Sure.
one thing people have brought up a lot is that there's a lot of pref equity funds that have popped up that people probably should be wary of. Not pref on a deal,
Yeah. Yeah.
So that's something that's come up quite a bit too, which is I thought where you were going to go with this, but yeah, totally get it. Like the LP, and this comes back to kind of the, investor sensitivity thing. At least on the upfront conversations, with retail, we shouldn't assume that they necessarily know what those numbers mean. And I think that's kind of what you're getting at. Like it's kind of a little bit of a marketing play.
They just know that their buddy and everyone else told them you have to have pref, and an 8 pref is better than a 7 and a 10 is better than an 8. But if cash on cash in the first 5 years of a 5-year deal is sub 5%, what did any of those pref numbers mean? I mean,
sure,
nothing,
and right. Deal still has to perform.
Yeah, absolutely. Yeah. So that has been my take on it. I think we're getting into a world of we've gone through an interesting market. I wish everyone would band together and let's make these deals less complicated for the retail investor, because to your point, like you just said, a lot of these retail investors, because they know the terminology, think that means they understand the deal. And that doesn't mean you understand the numbers. Like ask for the full underwriting sheet. We're real big on, you want to see the whole underwriting packet? I'll send you the whole spreadsheet, dive through it, but don't die on a hill about pref or asset management fees or anything if you don't even understand. Like I've had people go, oh, the IRR is too low. I'm like, well, what are your goals? Oh, well, my goals are to have X distributions, or I want to make, I need my quarterly distributions to be this. I'm like, well, then let's talk about what's the cash on cash and how much you're putting into the deal. Or the people I've had people that focus solely on, the multiple of the deal, but they need the cash, they're going to live off this cash flow. Well, and right. You're putting your money into a deal that all the upside comes from the exit or something. So I'm not saying none of those matter, but I just think pref is one. I'm not saying pref can't be a good thing. I'm saying we normally don't structure it in. That being said, if I had the right size investor come to me and said, I want to see an 8% pref and I could throw in an asset management fee and it offsets it, and that's what makes them happy with the deal and it doesn't change anyone's returns, sure, I guess we'd consider it, but we don't normally put them in there at all. And again, I'm not saying they're bad. What I don't agree with is the fact that people come in and say, no pref, the deal's dead to me, without even looking into it further, because you could be missing up a great deal over one little piece there.
Well, and the split in this case would be the neutralizer, right?
Yeah, absolutely.
Right. So, all right. Well, this has been great. We probably should wrap it up. But before we do, why don't you let the audience know where they can find you?
Sure, absolutely. So our fergmarcapital.com, our website, is normally the best place. I'm also on LinkedIn and all your socials, but fergmarcapital.com, there's a call, email button, everything. And we'd love to visit, whether it's with other investors, other GPs that are listening to this. I love to just have conversations and learn. So
good. All right, man. Well, thank you so much for your time.
Yeah, thank you.
Thanks for listening to the Invest Clearly podcast. To find verified investor reviews or to claim your GP profile, please visit investclearly.com. If you enjoyed this episode, please remember to like, subscribe, and leave a review, because that's how other people find the show. Till next time, invest clearly.